And hello, everybody who has joined our session. Uh, let's get started. I see that we have a few participants already. For those of you who are in the session, you might see yourself alongside the other panelists. Don't worry, you are not on camera on the panel. That's just how the WebEx platform situates all of us as attendees. So welcome everybody who is here today. We're going to jump right into things. If you're here for the investment deep dive session, our last session in the ScaleUp series, then you are at the right place. And you can see our panelists already on screen. So welcome to our panelists and welcome to everybody who is here as an attendee. First off, I'm going to jump into the land acknowledgement. So we acknowledge the lands which constitute the present-day city of Mississauga as being part of the treaty lands and traditional territory of the Mississaugas of the Credit First Nations, the Seneca and Attawandaron and wider Haudenosaunee Confederacy and the Huron-Wendat First Nation. We recognize these peoples, the Anishinaabe, the Ojibwa, nations within the Haudenosaunee Confederacy, the Huron-Wendat, and all other peoples who inhabited these lands since time immemorial. The city of Mississauga is home to First Nations, Métis, and Inuit peoples. As a municipality, the city of Mississauga is actively working towards reconciliation by continuing to strengthen our relationship with Indigenous communities. We formally recognize the Anishinaabe origins of our name and continue to make Mississauga a safe space for all Indigenous peoples. And our agenda for today, I will provide a very quick introduction to MBEC, Mississauga Business Entrepreneur Center, and MBEC for short, our ScaleUp series. Then I will introduce our speakers that you already see on screen. And we're going to jump into our panel discussion, and then we'll have some time for your questions at the end. So please feel free, as questions are coming up for you, to type them into the chat, and I will read them out after our panel discussion. So the Mississauga Business Entrepreneur Center, or MBEC for short, we are part of the City of Mississauga's Economic Development Office. If you are starting a business, then please feel free to connect with us. We are your central source for small business information, resources, and guidance. And we're currently providing support and services remotely because of the COVID-19 pandemic. And our hours are Monday to Friday, 9 a.m. to 5 p.m. We offer things like free business information and guidance, webinars and workshops, resources and tools, training and mentorship programs, and entrepreneurship programs like this particular scale-up session that we're in today. Other things notable to mention, we have business advisory services, the digital Main Street program, Starter Company Plus program, the Summer Company program, which applications will be opening in the new year, so keep an eye out for that, and other additional training and workshops, which you can find at this URL on screen. The future is unlimited.ca/small business/training webinars workshops. And here you can find the upcoming events, webinars, and workshops that we have coming down the pipeline. And also you will find recordings to our past webinar and workshops that has already happened. So if you want to review the ScaleUp series, for example, and the other workshops that have already occurred, then this is the place to go to find the recordings and to rewatch and to review the materials that were shared there. We are here to help. If you have any specific questions, please feel free to reach out to us. My name is John. I'm the Entrepreneurship and Innovation Specialist. Susan Lovelace is our small business consultant, and Laura Dunkley is our digital marketing consultant. So if you have any specific questions, then please feel free to reach out to any of us, and we're happy to chat with you. You can also email our general email, mbeck@mississauga.ca, give us a call at 905-615-4460, or visit our website for more information. And don't forget to follow us on social media, Instagram, Facebook, LinkedIn, Twitter, @Mississauga EDO. And our scale-up series, so we are in the last of our 8 scale-up sessions for this year. Lots of exciting stuff happening. So again, you can review the recording at the past webinars and workshops URL. And this session, along with the other 7, have been part of a series of 8 learning sessions that are capped off by mentorship, pitch practice, and a pitching opportunity in 2022, next year, designed to help innovative companies using Industry 4.0 practices. If you are a scaling company with $100,000 to $2 million in revenue, or if you have patents or you have patent pending status, or if you've raised pre-seed or seed capital, this is the program for you. This program is especially meant to support innovative companies founded or led by individuals from underrepresented communities. You'll receive these learning sessions, or you would have received these 8 learning sessions, including the investment deep dive one that we're here for today. And if you fall within the scale-up definition as previously mentioned, then you will be eligible for the invite-only sessions in the new year as well. So if that's of interest to you, and if you think you're eligible, please reach out to me. We'd love to chat with you more about the ScaleUp series and the ScaleUp program pilot that is currently underway. Now, for what we're all here for, our speakers for today, pleasure to introduce Scott Pelton, Brenda Hogan, and David Wright. Scott is a co-founder of Risk Capital, Canada's first disruptive technology deep tech early stage fund, supporting one of the fastest growing technology markets in the world. Scott has over 20 years of venture capital experience, and he has made over 50 investments since July 2020. Scott Pelton is a co-founder of Risk Capital. I already said that. Welcome, Scott. Big round of applause.
Thanks, John.
Thanks for being here. And Brenda Hogan is the Chief Investment Officer of Ontario Capital Growth Corporation, which is the venture capital investment agency of the Government of Ontario. And OCGC for short, was created to promote and develop the venture capital sector in Ontario. Brenda has over 15 years experience in strategy and execution in venture capital at the co-investment fund of funds and fund level investing, and has held senior roles in companies like Bell Canada, Ernst & Young, the Business Development Bank of Canada, or BDC for short, and also a software startup. So welcome, Brenda. Thank you for being here.
John, glad to be here.
And last but not least, we have David Wright. David has spent his career supporting technology-enhanced high-growth companies as an equity research analyst, investment banker, and corporate advisor for all levels of corporate maturity. Through Casio Capital Advisors, Inc., David provides capital markets, corporate finance, and transaction advisory and valuation services. David also advises early-stage entrepreneurs as an entrepreneur in residence at Innovation Factory in Hamilton and also at Haltech in Halton Region. Welcome, David. Thank you for being here.
Morning. Pleasure to be here.
All right, so I will stop sharing my screen and we're going to jump into a bit of a quick intro. So Scott, I'm going to hand it over to you first to introduce yourself, your organization, and why you think we need to take a deeper dive into this topic of investment. Keep in mind that we had a previous session on finance options that talked about loans, grants, and investment. Why do you think it's important to dive deeper into specifically investments?
Yeah, thanks, John. So I'm Scott Pelton. I'm on my phone. If there's some video or audio problems, let me know. John and I met through some volunteer work I was doing in my hometown of Brantford when John was supporting some work with Laurier there. It's nice to be working with him again. I'm a computer engineer originally. I set up this fund with a friend of mine a couple of years ago, and we're targeted investing in early stage deep tech opportunities. And we define deep tech as high degrees of technical risk. And when I worked at Silicon Valley in the 90s, it was something that Silicon Valley really got, whether it was through partnerships with Stanford or government procurement partnerships and things like that. And so I've come back. I've been working and investing up here for the past 2 decades, and we set up Risk to help companies to be more like that. and to take more technical risks. We think our country will be a better place for it, and that's why I'm in it for. So I'm here to talk to you folks about interesting ideas for funding, really risky technical ideas, as well as experience from my career as a Series A and Series B investor. So thanks again for having me, John.
Amazing. Thank you, Scott. Over to you, Brenda.
Well, I have a bit of a checkered career. I actually, one of my first jobs was with a startup company, and I very quickly realized that I wanted to be on the other side of the table. In other words, I wanted to be distributing the capital as opposed to looking for it. But my whole career has really been the theme around building business in one way or the other. And when we think about the financing options and the investment piece and why it's so important, I don't have to look very far for a really good example. We're an early stage investor in a company called Ecobee, which exited a few days ago to Generac, $1 billion valuation. So $1 billion valuation on the Canadian landscape is not insignificant. And when I think about the Ecobee story, having been with them as an investor for the past 10 or so years, they were really thoughtful as they went along as to who was going to be on the cap table, how they were going to manage and interact with their investors, who they wanted as part of that investor story. And so when it got to the point that everybody was ready to monetize, that groundwork actually stood them in very good stead in terms of making sure they found the right partner, the right valuation, and that the mechanics of the exit, that the investors were aligned, the board were aligned, et cetera, et cetera. And so it's been a good news story for everybody. The investors monetized, and I think everyone's been very pleased with that. The employees now have a mammoth company behind them to take them to the next level here in the GTA area. So again, a lot of that success goes back to, having the right product market fit, but also having the whole investment piece really well thought out from the get-go.
Mm-hmm. Yeah, very well said. Thank you, Brenda. David, over to you, about you, your organization, and why investment deep dive is important.
Terrific. Thanks. Good morning, everyone. So I was kind of born as an analyst. Prior to the stock market, I was hired as an analyst at consumer packaged goods companies. I eventually became an equity research analyst and was very fortunate to be kind of at ground zero of the tech bubble back in the year 2000. At that time, there were just so many companies going public, and I understand it's kind of gotten back to that period today. I was fortunate to see names like OpenText and Descartes go public. And so I saw them from very early stage grow into multi-billion-dollar companies. And all along the way, I realized that, to understand a company really helps if you sit back and ask your own questions about how it works and think of it from a consumer standpoint. So I went on after being an analyst to be an investment banker, and I helped companies buy other companies or sell divisions. And again, I came back to my roots, which was sometimes a CEO thinks he knows how to present a company, and it helps a lot to ask the questions about what the basis of the business is and what drives it, because then that opens the door to insights into what makes a company tick, and therefore the valuation issues and that sort of thing. And I continue to do that today to help companies surface their value. And to the question at hand, raising equity enables you to grow your business beyond your own resources. So that's why it's important. It's one thing if you are self-funded and you get going, but if you pour in a bunch of capital, you can often grow much faster. But the issue for an entrepreneur is they're so focused on their business, they don't understand the finance industry. And the finance industry has its own set of jargon. There's knowledge and insights from people in the industry that they have. And so it's great doing a deeper dive like this because it provides a little bit of the insight as to what the expertise is about and the important points when you are looking to raise money yourself.
Mm-hmm. Amazing. Thank you, David. So, David, you mentioned companies like OpenText, the bubble of the
tech bubble,
late 90s, early 2000s, and what sparks in my mind is there seems to be a correlation between investments and, say, tech and innovative companies. So what role does investment and equity financing play that makes it such a common vehicle for innovative companies?
I think what it is that you can you can service the world from one computer in your room. There aren't many other businesses that scale that way. And so that's why if you pour in a little bit of capital, you can get to a very early stage break even. And again, you can service customers all over the world from your bedroom basically. So that's why it's the type of business that gives great returns from the investments made, and that's why it becomes so attractive, and why what we saw with the internet was really a change in sales and marketing tactics that enabled this grand scaling. And so, bricks and mortar businesses kind of had to change over to have web addresses and web sales. So it really transformed many different industries from nothing to being billion-dollar organizations. So that's
I
why
think the other thing I would say, John, is that for companies who are earlier stage, I mean, unlike your traditional manufacturing company, like there's nothing to lend against, right? There's no big heavy equipment, there's no big building you can lend against. Oftentimes there's no revenue, there's no cash flow, right? So it kind of defaults to venture or some form thereof. So that's sort of one piece. The other piece is that when you think about quote unquote how easy it is to start a company, I know for anyone who started a company, it is not easy. I get that, but when you think about what it takes to kind of get a product up and running, you kind of can't, when you think about the competitive market, if you were to sort of bootstrap your way along, it may take you 10, 15, 20 years, right? Meanwhile, a competitor blows right by you. So, a lot of the companies we see in the market today that are technology based, they need a significant amount of capital fairly early on and for a number of years so that they can get the product out there, get the beachhead, get that network effect going, get the customer base being super sticky, and get that root system out there so that they have a defensible position out there in the marketplace. And so again, doing a venture round, the idea, or one of the ideas of it, is that you get a significant amount of money that allows you to sort of catapult yourself to that next stage of your business strategy.
That's very well said. So that's a very great point, about the competition. And Scott, from your standpoint, because you're focusing on deep tech and you're looking to de-risk the tech, the time it takes to create that kind of product or to run that kind of business perhaps is a bit longer than what David might have described. From your viewpoint, what Brenda said about the competition and injecting funds in order to deal with the competition so that you don't get outrun by a competitor, like, does that hold true for what you see in the companies that you invest in?
It does. I think the competition, it's funny, John, there's not a lot of competition for deep tech investing. So when you keep saying competition, I'm like, it's actually really easy to do what I'm doing because there aren't a lot of people patrolling universities and colleges looking for, relationships with professors and so on, right? They're mainly the rigor is sort of SaaS investing these days, but we're trying to read ahead. I think at the stage that we're investing in, they just need people that get the idea and that have connections and that can help them fund the idea to a proof of concept or to some sort of a valuation accretion milestone. And that could be NRE money from a pilot customer that, there's lots of creative ways to get funding. From our perspective, my partner Colin and I, when we invest, we want to get as many proof points so that we can get the Series A after 18 or 24 months. We're less worried about competitors at our stage.
Gotcha. So that's really interesting. So that sparks the question of, okay, so you mentioned, you're reaching out to faculty, perhaps, Scott, to find these new technologies, these new companies that might be born from research. So do you get more of companies reaching out to you, like via cold emails or cold phone calls, or reaching out to you on LinkedIn, or are you taking more of a proactive approach to reach out to the faculty members who are doing some really cool research? That was Steve, Scott, yeah.
Yeah, sorry, my camera's crap, so I keep turning it off. We're finding, I mean, we have a lot of inbound interest after doing this for a while. Lots of folks track you down, but it always makes means a bit more if you have to work for something. So, you know, I love talking to the Memorial University folks. I love talking to the Dell Tech folks. I love talking to Waterloo. And so we do sort of reach out to those groups. We're quite involved in the NSERC and their eye-to-eye commercialization grants. John McRitchie and what he's doing with the DMZ. John, what you're doing and what Pam Banks is doing at the Rick Center, and it's all good stuff, right? But so we do try to stay engaged, but it's kind of easy to be lazy when you're the ones that are writing the checks, but I've always just found the best deals are the ones I have to chase.
Very interesting perspective. So David, flipping that question to you, like how much chasing do you do, or do you get a lot of inbound leads looking for early stage angel investment?
So I can tell you that I was running the local angel group, Angel One, which is in the Mississauga to Hamilton region, and they're now part of a group with 3 other angel groups called Equation Angels. And we would see about 50 or 60 applications a month, and each month try to narrow that down to 3 presentations. And I could tell you that on average, the network would probably invest in about 1/3 of those. So that's how competitive it is. You know, one in 50, 1 in 60 that you're actually getting money. I totally understand what Scott says, is it always feels better if you're reaching out to someone to find an investment opportunity, as opposed to, you know, you're the 5th or 15th time that someone has reached out to someone and they get to you eventually. That doesn't feel as special, but you know, so that's how competitive it is for money these days. Lots of people with lots of ideas looking for funds, and you know, with COVID, I would say, at least 1/3 of our members kind of put their money on the shelf, waiting for in-person meetings again. So it got even more competitive during COVID.
That's very interesting, Brenda. You know, from the fund of funds standpoint, is that what you're seeing as well? That investors are saving a bit to.
No, I think what, you know, the first month of the pandemic, which was about 2 years ago now, I think there was a lot of, you know, people didn't know what was going on. A lot of people had to sort of shore up, practically speaking, their personal, you know, lives too before they could actually sort of get on with it. But, you know, I think nobody wants to miss a great opportunity. And so what I really see this pandemic as being is putting us on the path to democratization of the whole investment business. Because you think about before the pandemic, everyone kind of, you know, sat in their cubicle, or they went to a cocktail party, or they went to a pitch session. Well, what if it wasn't convenient for you to physically get to that pitch session for whatever reason? Or what if you're a company and you're in a geography where it's a challenge to travel? Was that fair? And so I think what people have come around to realize now is that you can build great relationships using the tools that we have. And I would say that when we think about these video tools that we're using, we're still only using about 10% of the capability. And so, you know, I really see this as an opportunity to not rush back to what we were doing before, because let's all be very frank, that was not working for everyone. We were just doing it because that's all we knew. Now we are so lucky because we're, you know, for the first time in about 100 years, we have a chance to create a model that actually we can build ourselves to actually work for more people and be more effective. So I'm really excited about that. And so I think what people realize is that if they're going to do due diligence over, you know, a video call, what does it make a difference whether the company's in the GTA, or Sault Ste. Marie, or Ottawa, or pick any geography you might like. And likewise for the entrepreneur to be able to access resources regardless of where they may happen to be. So I'm really excited about taking innovation in terms of making this a bit more democratic. I think with regard to the, you know, founders reaching out, I guess my perspective there is that this is a high-risk business venture, right? If it weren't, it wouldn't be called venture, it'd be called something else. And so I think one thing that entrepreneurs can do to set them up for success is 2 things: is, you know, build relationships with potential investors before you need them. Leverage the relationships that you have. And then when you do approach an investor, and I would say this, whether it's an angel investor or a VC, is that understand what they're interested in doing from a thesis, understand the stage, understand where they are in their capital raising cycle, because sometimes an angel or a VC will say, you know, I've made my commitments for this year, or for the next couple of years, I have no more money. So you kind of want to understand where they're at there. And then understand where would you fit in their portfolio. For example, is there a gap in their portfolio, and the technology you have would actually round that out? So when we think about product market fit, I also like to think about company investor fit.
Mm-hmm. I love that because it's all based on relationships, right? So we have a question here in the chat that I think is very relevant. Is investment typically monetary or can it be more than that? What's the basic type of investment? So, Brenda, you talked a little bit about the relationship, and Scott, we've had chats about how important it is for the startups, for the entrepreneurs to also qualify the investors and, like Brenda said, find out where you fit in the portfolio. What are those other things that people might not think about in terms of investment, aside from just the money changing hands? And what do those relationships look like? Open to anyone to jump in.
If we talk
Well, I mean, I
investments
think back to an example. I think back to an example years ago. I remember, everybody knows Georgian Partners now, right? I remember this entrepreneur telling me, he's saying, "I don't want money right now. I don't need money right now, but I really want the Georgian team behind me, so I'm going to find a way to take their money," right? And so I think that was a really good example of an entrepreneur who understood, the value of tapping into someone else's network. In terms of building out your board, building out your staff. Building out your next round in terms of syndicate, international context. So I think, there are opportunities to get an investor that, of course, brings capital, but brings all that value add with it.
Mm-hmm. Amazing. Scott?
I would just say at the earliest stages, to me, get investment just means getting cash in the door. So, it's revenue, it's grants, it's venture capital, bank debt, although bank debt is terrible at early stage. But the coolest thing that maybe some of your clients or some folks in Mississauga can pursue or Peel region would be prizes. Like I'm seeing a lot of deep tech cool things like Carbon Cure and the X Prize and things like this. These are like deep tech funds like mine. We can solve really big problems. And there's a lot of billionaires that have prizes to help with that. And so like Google the X Prize if you don't know about it. I just want to make sure that's mentioned.
Mm-hmm. Amazing.
And John, I'd say that with very early stage companies, it's all about business development. And when you look at angels, it's a little bit different than the venture marketplace, because a fund usually has a philosophy and you can kind of figure out where that fund is going. Whereas if you get a group of angels, you've got just an array of people. Some are doctors, some are lawyers, some are entrepreneurs themselves, engineers. So when you look at the money, you should look at the individuals and what contacts they bring. So obviously, if you're in the medical field, it might be great to have some doctors that have connections to various research hospitals or whatever. If you're in another industry, you look at maybe the entrepreneurs or the engineers to say what relationships do you have that you can open the doors for me? Because obviously, if they invest, they want the investment to do well, and so you're also hiring their Rolodex.
Mm-hmm. Yeah, so there's an element of expertise, and possibly some of that expertise could come from your investors and the relationships that you build from that end of things. So I want to clarify a couple of things because David, you are an angel investor. Scott, you are a venture capitalist. And Brenda, you are working on funds of funds, and you help the venture capitalists. So from your perspective, like what happens when an entrepreneur lands across your desk, right? You get a company, somebody says, this might be worth looking into, or maybe you get a LinkedIn message. However that's coming in, you have a company that you're looking at. How do you respond from there? What are you looking at, like in terms of the granular steps? What's your email replies? What does that look like for you in your stage of the investment process or the investment cycle, essentially? Let's start with David because you're the earliest stage.
The earliest stage?
Yeah.
Yeah, early stage, you're trying to understand the concept. So, I mean, very simply, I would say, send me your pitch deck, business plan, some kind of summary financials and projections. And you need to be able to describe your business very succinctly. I don't want paragraphs and paragraphs of what it is. You need to get it down to a couple of sentences as to what you do, and it's got to be crisp. That will indicate to me that if I can get it that quickly, then obviously your sales process is going to be much easier. So that's what I'm going to start with. What's the concept? Give me the background. Later on, as we get into the more nitty gritty, I'm really going to take a look at the financials, because that tells me how the business is designed to run, what your marketing channels are going to look like and that sort of thing. I'll look at your historical financials to see, have you put any money in the business? What your cap table looks like, who else is invested, that sort of thing. And then I'll look for research that has given you this idea. I'll want to know the background research and what you've done to come up with this idea. And then look at if you have any customer names or surveys that you've done to indicate what the customers think about it. That's what I'll be doing.
Amazing. That's an amazing list. So I have pitch deck, business plan, projections, succinct description to start, and then later on, if all goes well, you're looking at things like historical financials, cap table, other research, surveys, other data from customers. Scott, how does that differ at your stage of investment?
A lot of what David said is the same at my stage, John.
Nothing else different. So is there one perhaps or a few elements that perhaps you would focus in on more specifically at your stage? Scott, are you there?
But he might have trouble, but the one difference
maybe
would be that at an early stage, companies don't necessarily have customers. And so that's a real challenge, because you have to really anticipate what the customers will say. So that's where surveys come in. And the forecasts are the forecasts. I mean, you can't really do much with it. Once they get up and running, the next stage is when you have customers and you're growing. It's now the focus would probably be more due diligence on the customers, why they're buying the product, how they're using it, what other opportunities there are. So that's kind of where the shift begins.
Mm-hmm. Yeah.
While Scott's getting calibrated, maybe I'll offer a couple observations, John. One, I think David, really, to touch on a point David made about the value proposition. I recall years ago when I was at Bell in the venture capital group there, we had a portfolio company that was quite troubled. And so I got on a plane and I went to a trade show with the CEO of the company, just to kind of see how is he interacting with people, what's he saying. And within about 5 minutes, I saw the problem right there. He could not articulate the value proposition. Right? And that was the key issue that he had. I think the other thing to sort of think about is the other thing I would look for, and this going back to more the days when I did it direct investing, but I even ask my fund managers now, how they're thinking about it. But is the problem the company looking to solve? Is it a big enough problem for a big enough number of people? And will those people be prepared to pay a big enough number to make the business model in case viable? And that to me is a fundamental question that, when something, would come across my desk, I'd be very keen to get grounded on very quickly.
Mm-hmm. That's very important, because, entrepreneurs all over the place are working on important problems with innovative solutions. It doesn't mean that if they don't get funding that they're not working on something important. It's just not.
I think you're right, John. Let me be clear. Not every company is going to be $1 billion valuation. Like, we need companies of all sizes along the spectrum. I think, though, for an entrepreneur, it's important that they understand pretty quickly, where will that company be playing in the space, because and then you start making decisions around what kind of investors you should go after, et cetera, et cetera.
Mm-hmm. And
Hey, John,
awesome. Yeah, I was just going to say, because Brenda had mentioned before that we might be using like 10% of our technological capabilities in this virtual environment. I feel like webex might be like down to 1%. So, Scott, let's see if it's working.
My video is just going to have to stay off. It crashed my phone. I'm sorry, guys. So I would just, David, you were telling it, I would have a similar process to what you would. It's just that at the stage I'm investing in, I'm also going to want to talk about an IP portfolio and what the IP strategy is. Are we going to be protecting it? Are we going to be chasing people? Or what value do we have? Do we need additional IP? I spend a lot of time on that. And also, just to add to what David said, I try to tell my own story, and then I try to play it back to my partner. And I say, okay, so we figured out how much money they've gone in. What's the angle of this individual? Do they just want a paycheck? Do they want to change the world? Do they want to become a billionaire? Like, what are they in it for? And so I just try to tell my own story. And then, I do have a partner that owns half of Risk Capital and named Colin. I bounce it off Colin and I get his perspective because even though we're both engineers, we're both very different. And so, and if I'm satisfied at the end of that, then, we make a determination. Once we've heard the entrepreneur tell their story and we look through the material and then we play the story back to ourselves, then we make our decision.
Mm-hmm. That's I love that what you said there, Scott, about you telling your own story because to a certain degree, it also has to resonate with you personally, right? The journey of the entrepreneur. Um, if you weren't investing in a particular industry or you weren't compelled by that problem, then you wouldn't really be able to work with that entrepreneur outside of just providing the cash, which isn't something that you're looking to do, right? You want to work with the entrepreneurs.
Yes.
Mhm. So I want to get to like closing of the deals, right? So yes, we're evaluating pitch decks, business plans, the articulation of the value proposition, the size of the market, the problem. Are there enough people to pay for it? And of course, other big buckets like IP. Is it defensible? Do they have the registered IP? How strong is the team, as you had mentioned before, David? But what are the nitty gritty type of documents or things that need to be in place in order to close the deal? And I ask this because um, when I first started my first company, I was speaking to an investor and they asked me for a pitch deck. And this was back in, when I was a kid. I I had to scrape one together, in a night. And of course, it wasn't very good. So what are some other, documents, things that need to be prepared in order to really close that deal successfully? What are those nitty-gritty things?
I can go first.
I mean, you've got to be able to articulate what the concept is very succinctly. But beyond that, we're going to look at contracts, especially if you already have revenues, but we're going to look at employee contracts. We're going to look at the type and number of customers you have. Is this a business where you have one large customer that could, change their mind at a moment's notice? Or is this a business that you have lots of people giving you $10 a month? And they're locked in. So that's the type of thing that we're going to, depending on what your industry is, so really we're looking for the drivers behind the business. We're trying to understand who you're competing with. And often what you're competing with is the old way of doing things because you're introducing a new way to do something, right? And so we have to evaluate what will be the reaction of the previous competitors, because if you're going to come in and take over a chunk of the market, they're going to react to you, and how can they react? So we'll want to understand that. That's where I'll be focusing.
Hmm. I think Scott, you were jumping in there.
Sure. Yeah, there's the mundane things like making sure that your bank account statements are current. That there's a whole bunch of questions that you want to be ready to answer as soon as the investor asks, right? Like, send me your financials. If the answer is, can you give me a week? Then you blew it, right? Like you should say like, I'll get them to you tonight. I just want to refresh them quick. You can get away with that, but you should have them all handy. The minute book is important. David, you talked about contracts. One question I like asking is, are all the contracts the same, or who has special treatment? And if I see that different customers have different contracts and different pricing, and different employees have different bonuses and different equity, and it doesn't kind of make sense to me, then I just think it's complicated, and I just like simplicity. So the best thing an entrepreneur could say, look, everybody has the same employment contract, including the CEO. We might get paid different amounts, but we just want to keep it straight and simple, and we don't let anybody negotiate those things beyond the template. Like, I like that, right? Because it's just easy to me, and it means that they're focused on building the business versus sort of minutia, but the minutia is important.
Hmm. Yep. And Brenda, what's your perspective on nitty-gritty documents that are necessary?
I mean, in addition to what's been covered, obviously, anything to do around IP, who owns the core technology, would be very important. And who actually owns parts of the company. I know that might seem like a very obvious question, but I can think of situations where you know, there was confusion around who owns what. And you can imagine where this comes into a problem. Even basic things like, okay, let's say you get an investor who actually wants to invest, you may need to get someone to sign. Well, if you haven't seen that person in 5 years and you can't get a hold of them, that's an issue. So just, I think back to Scott's point, just, you know, having your house in good order, because I think, just to use the house analogy, I think investors, and back to David's point, there's just so many companies out there now raising money. Everyone's plate is pretty full when you're looking at opportunities. And it's like when you go to buy a house or buy a condo, you walk in, the place looks great. Okay, I'll pay full price. And then you see the doorknobs falling off, and then in the kitchen, the stove is kind of not in great shape. And then by the time you go through it, not only do you not want to pay the list price, you don't even want the place. And so don't be the one with the doorknob not working. You know, as an entrepreneur.
That's an excellent point, and what a great analogy, right? Because those things that seem to be a bit off the rails and you're not keeping the house in good order, perhaps are indicative of larger problems within the company, right? Perhaps things are not being disclosed, and you know those are things that perhaps might be seen later on if an investor were to engage with you and actually invest, and they would be in a long-term relationship, right? So those things are going to come out. So if you don't have your house in order, then it's kind of a bit of a red flag, right?
Yeah, and beyond that, the other thing I would say is the conversations that you have with the investor the whole process along, because you know, you want to make sure that the person's really good at problem solving, because that's really what entrepreneurialism is solving problems. And you know, if you're telling the investor, well, I couldn't do this, like to Scott's point, oh, because my computer crashed, or you know, I just don't have the things ready, or I couldn't go to the conference because I, you know, couldn't make time for it, or you know, there's the pandemic now, so I don't know how to get a hold of something. Like those are all things that you should be able to solve for, and those are things that instill confidence in the investor that, yeah, you're going to hit a brick wall many times, but if you can demonstrate that you're someone who can solve for problems, that really puts you at the head of the pack.
That's a great comment, Brenda. I agree with that. And one thing that we're looking for is an indication of how you solve the problem, and are you considering other individuals or other parties that are affected by how you solve the problem. For instance, let's say you have a compensation issue, and you have a compensation issue with one individual, so you give them a special contract. What does that mean for the other people if they ever find out about that contract, which could be with customers or whatever, right? So are you the type of, so what sort of culture are you establishing? Are you the type that deals with one-offs with everyone, and you just solve the problem of the day without looking forward? Or actually are you trying to solve things, you know, let's do a policy for this and a policy of that without being too bureaucratic in the process? You know, so raising equity, sometimes where you see it is on the cap table, where you've got all different types of equity and multiple voting shares and this and that and the other thing. It's like, whoa, way too complicated. There's no reason for that. You should treat, you know, you treat your investors the way you treat your employees, and you know, things you shouldn't be trying to isolate individuals. That would be my philosophy when I look to invest.
Yeah, so there's an element of solving the problem and how you go about solving a problem, the logic that kind of led to those decisions.
Yes,
So
right.
I'm wondering, from your perspective, you know, do you have an example of conversations where you've had with entrepreneurs and you found that, yeah, their problem solving isn't really aligned with what we would do, and therefore the deal didn't go through? Or do you also have an example of one that went really well, and you ended up investing in that company? Do you have examples like that that you'd be able to share?
Yeah, I won't say the name of the company because we're in the middle of it now, but we're speaking to a company, and one of the risk advisors is a power engineer that really knows DC to DC power conversion, and so we spent an hour on a call with my advisor going over it, and my advisor was very negative on it because the investment pitch was very promotional, and it didn't go into the technical jargon was getting mixed up, and my advisor was trying to figure out if they're trying to sell me snake oil, you know, like the proverbial the thing that everybody wants to buy, but it's never going to solve the problem, right?
Not you, Scott. I can't imagine anyone would try and put one over on you.
But that's right? I mean, if that entrepreneur had known better, maybe they would have focused more on the tech, right? And less on the sizzle. The sizzle is important for these investments, but John, to that point, like I've seen entrepreneurs that are very, very good dressers, very nice haircuts, like really well presentable people, very good talkers. But when we go into the tech, either the person who really knows the tech, he or she isn't in the room, or the individual that's giving me the pitch doesn't know it, and it falls apart. And that's just not, that investment really shouldn't have happened, or that meeting shouldn't have happened, because it was just, I couldn't help them, and really he couldn't help me either. So.
Mm-hmm. That's so what you said about, having the right people in the room, to speak for certain elements. Like if it's the tech, you would want the tech person there to speak for it. If it's the customer side, you want the person who's been dealing with business development to really speak on those relationships.
That's right. Usually when I've got the CEO, I'm used to the CEO being a very good salesperson. He or she is good at selling the organization. And it's great to have the CTO in the room at the same time. It's difficult to have both in the same person, but whoever the CTO is in the room, it's helpful in a pitch with risk capital.
So there's also that element of the company structure, which is kind of to your point, David, about the not being overly process driven or overly bureaucratic about things, but organized so that it fits the function, and that is a good indicator that the company is on the right track, perhaps.
Yeah, and I mean, so let's say you have people running different functions, but then you get someone who's undermining the functions of another individual. Let's say the CEO is saying, "No, we want to do it this way." I mean, it's great to take direction, but at the same time, you don't want anyone undermining each other. So you do want to look at the culture within the group. Something that I like to see is I like to see companies present multiple times over the course of doing due diligence, and are they incorporating and are they learning as they go? And with very early stage companies, they have a concept, they have incomplete information, that's okay. But I like to see that if someone points out an inconsistency, that they adapt to it. So for instance, let's say, they make a projection about how big the market is, and then someone says, well, it can't be that big because of X, Y, and Z. What happens at the next pitch? Do they continue to say that the market's enormous, and someone says, well, or have they continue to thinking the market's that big, but they've adjusted their forecasts? I like to see them kind of digest information as they go and deal with it, as opposed to just, we're running and, get out of the way sort of thing.
To add on to a point David just made about culture, it reminded me of a situation. I was in one of these sort of deal pitch panels about 3-4 years ago now. And we were all really impressed by this one company. And the gentleman to my left, one of the other judges, he did some quick math on his calculator to see what the upside of this potential investment would be. Well, the calculator could not calculate the number that high. And of course, we all burst out laughing because he says, well, if the calculator can't calculate, we're getting an error message. It must be a good deal. This is fantastic. So I called him up the other day. I said, so-and-so, whatever happened to that company? And he said, well, he wound up being an advisor to it and investing in it. And then the owners and the investors got in a fight, and the company fell apart. And so, I think going back to David's point, understanding the culture of how that organization operates, how did the team come together? Why did they come together? Have they worked together before? How are they solving, problems? And getting a feel for that, is quite an important aspect, because we've seen a lot of teams do really well, but we've also seen some teams where the culture was not a good foundation.
Very good point, because it's, again, a long-term relationship, and there's the element of the culture of the company that the investor kind of has to fit into, or has to align with as well, because they're working together on a long term. But what I want to get to is another lens of looking at culture. If if somebody was a newcomer, if somebody was from another culture and they're unfamiliar with the investment landscape here in Canada, or perhaps even North America, and they might not have those relationships or networks that are built here, how can they navigate, the culture or the norms of investment? And if they were to secure a deal, do you foresee or do you foresee challenges of working with companies from a different culture, and how can that be navigated, as an investor?
Hmm. You want me to start, John?
Sure, yeah, Scott, yeah.
Okay. For my money, I think BetaKit is probably the greatest blog for a new entrepreneur or a newcomer to Canada to read, to just get a sense for the landscape here. It's Beta, BETAKIT, and they do a pretty good job of staying in touch with the investors, and they covered the equity exit, and that would be a good way to get started. I would say, I mean, me personally, my best rates of return have been in first generation Canadians, which is amazing, right? And it's great to help them and watch them become multimillionaires and make some money in the process. And I would, for risk capital, in my own perspective, I think it's totally fair for people that are just new to the country or new to this business to ask questions of the investor and not be intimidated. It's like the less I learned getting to know your doc, right? Your GP, and having a candid chat with them instead of putting your doc on a pedestal and just saying, you can actually have an interactive relationship. And as David said, there's a lot of capital out there, although not as much for deep tech, but it's fair to ask them, when's the last investment that you did? Give me a couple of references. Tell me about an investment that you made that didn't go well, and how was it at the end? And like, it's good to get into those because, and to Brenda's point, things can get, investors can also mess up companies, right? it's not it's not just the entrepreneur relationships that can mess it up. Like our presence on the board can be a good or a bad thing, right? And it's important for both parties to have that conversation.
So, David, what are some, and Scott's point there about, the entrepreneurs should also ask questions, right? It's a two-way street. So don't put the investor on a pedestal, do your own due diligence. What are some questions that were memorable to you, David, that an entrepreneur asked you that you thought, you know what, this is, they're also qualifying me, and that gave you an indication that, this relationship is heading in a positive manner?
Well, if you go back to, not only do entrepreneurs need money, but they need business development resources, right? So what they should be doing is asking me about my background, what I've invested in, what industries I'm interested in, where I've worked, basically trying to figure out, my LinkedIn profile and where I have contacts. I think communication is an important part of success eventually. So the entrepreneur that takes in money should be having a regular newsletter. And some entrepreneurs shy away from that because they don't want to discuss their problems. But what you do is, rather than discussing your problems, you say, I need help with this. Who knows contacts in this industry? Who's got this resource? So if you think of, if that's what you're going to do, then when you're looking at your investors, and if you have 20 people, if you're so lucky that you have 20 people wanting to invest and you're only going to take 12 or something like that, I'd be trying to figure out where the gaps are in my organization in terms of industry experience and knowledge of customers, and I'd be quizzing them around that background. So again, if I'm medical field, and if maybe I have already doctors on the board, but maybe I'm looking for a certain relationship with a research hospital, and I can find that. I'd be looking at the background of the individual, what deals they've done, what businesses they've worked in.
And Brenda, to jump off that point, Scott had mentioned asking questions, reading materials like BetaKit, and then David had mentioned, asking questions to know more about the individual investor, whereas Scott was saying, also that, and to learn about the investment culture and norms as well. What other suggestions do you have for entrepreneurs who might be from underrepresented communities who aren't familiar with the investment culture and norms?
Well, I mean, I think there's a couple things. I mean, one, you've got the people who may be newcomers, or the people, as you say, who may be from underrepresented groups. I mean, with regard to the newcomers, I think what's called the One Network here in Ontario, where whether it's OCI, Ontario Centres of Innovation, or your group, John. There's a lot of places where people can go to get help with a pitch deck that would resonate with the community, introductions to local, lawyers, introduction to, university connection, whatever you need. So I would encourage people to avail themselves of that. I mean, I think with regard to other groups, I think what people have kind of come around to is that you want to invest in the best people with the best companies. And so therefore we need to make sure, I think most investors are saying, we need all the blinders off and we need to look at all the opportunities out there. And what you'll often find is, the more diverse groups you look at, the more potential opportunities. There may be a group that has identified, I was on jury duty a few years ago, right? And it was and I say that because it was such a diverse group of people, and we'd sit in the room and someone would say, well, is this reasonable? And they know. And then one person would put their hand up and say, well, in my life, this is what we do every day. And everybody's like, oh, okay, I guess that is how it is. So, I think I think my point being is that if you look at certain entrepreneurs from certain backgrounds, they've identified market opportunities that other investors don't even see, just because of where they came from physically or in terms of their background. So I think that's a piece to keep in mind. I think on the point of and I also will speak from the LP, from the investor who invests in the venture capital funds. We want those funds to invest in the best companies, and if they're only investing in companies of a certain with certain backgrounds, then it's hard for them to convince their investors that they're really looking at everything out there. And if you're not looking at everything out there, then you're exposed to risk because you may not be seeing the best deals. So that's the first part. The second part, just on the matter of getting to know the investor. I think, it's very helpful to understand from talk to other CEOs, other people that investor, that whether it's an angel or a venture, has invested in. And oftentimes there'll be press releases, going back to the beta kit piece that Scott brought, where we'll say a company closed around and the investors were X, Y, and Z. We'll call up those investors and talk to those CEOs that took money from them. And then beyond that, understand, have those investors actually help shepherd a company through to exit. Because, the most successful investors, they've probably done it a few times. The CEO's probably never done it, and they may never do it again. It may be a one-time thing. So, look to see. So I guess my point being is look to see what value that investor will bring beyond the check. And going back to David's point, if you're in a med tech company, then maybe, you should be asking that particular medical professional or doctor, what has been your experience in this sector with this technology, and understand, is it really something they can bring to bear to your company?
Yeah, that's so critical. So there's a lot of research that the entrepreneur can do on their end as well. And I know that on Crunchbase, actually kind of similar to BetaKit, right, and the news releases that you mentioned, if you search up a company, information will pop up about how much the company has raised, how many rounds they've gone through, who was the leading investor. And a lot of times that information is captured there. So that's another useful tool that entrepreneurs can use to really do that digging, to understand the investment culture, to understand the individual investors that have participated, who might be similar. And also, you mentioned from the fund of funds perspective, going back to your initial point about, or one of your initial points about rounding out the portfolio, right? It seems like investors are looking for that kind of diversity as well. So as an entrepreneur, doing that kind of due diligence might help you to find out where the investor might fit in or where you might fit into an investor's portfolio. So we have, yeah, sorry, go ahead.
I'd also mention, at the risk of mentioning what might seem like competition, but in fact it's collaboration. The other RIC centers, right? The Research Innovation Centers. I'm a EIR at both Haltech and Innovation Factory, and then of course there are many other organizations, and they seem to be all developing their own special, unique proposition in the marketplace, while also providing general services. So why I mention this is that there's no cost for an entrepreneur to join and participate with multiple research innovation centers. So I do encourage them, if they're in Mississauga, to come to your organization and get general skills. But at Haltech, they have a program called Beyond Boundaries, which is specifically geared to female entrepreneurs. And it's been very successful, and there's no reason why a female entrepreneur from your region could also be part of the Haltech group, especially today with Zoom meetings and that sort of thing. And so depending on the organization, they should look at the other innovation centers to see if there is a particular skill set or knowledge base that they can tap into.
Yeah, very well put. There are lots of organizations who are willing to help, and most regions have their innovation centers. And Scott had mentioned the RIC Center, which has now rebranded to Altitude Accelerator. So for those of you who are in the Peel region, who are in Mississauga or Brampton, Altitude Accelerator, Pam Banks over there is great, one of our partners. So definitely reach out to all the resources that are available to you. Brenda had mentioned OCI, Ontario Centers of Innovation, and the One Network. So lots of resources available.
Yep.
We have a couple minutes before I want to jump into the attendee questions. We have a few of them in the chat. I want to do a really fun game type of thing where it's a lightning round. I'm going to throw a term at you, and you're going to give me a 1 or 2 sentence definition of what this means, because perhaps some of these terms, for somebody who hasn't raised around, they might not be as familiar. So I'm going to say your name, I'm going to give you a term, and you're going to give me a 1 or 2 sentence definition. Any volunteers to go first?
Do we have to ring a bell or honk a horn, right?
Yeah, you actually have to make a note. You have to make a oink with your face. No, I'm kidding. But I did not come prepared with a bell. I should have, or like the Staples. That was the easy button. I'll start with you, David. Pre-seed round definition.
Yeah, I'd say that's a smallish round, well under $2 million. And it's, would be around likely before revenues, maybe just into revenues. Once you have significant revenues of, let's say, over $1 million, and that you're able to raise more money, and that becomes the seed round of 2 million or more. So it's somewhere probably $1 million ish, but could be much smaller, right? Could be 200,000, 300,000.
Thank you. And Scott, seed round.
Seed round is when the company has probably finished the pre-seed, but they're just starting to get to know the institutional investors. So they're going to get a bunch of no's from Series A investors, or they're going to get hopefully some yeses from guys like me.
Awesome. And over to you, Brenda, Series A.
Yeah, I find these stages that they evolve over the years, but generally speaking, by the time you're there, you've got a product, you've got a few customers, you're a going concern.
And back over to you, Scott, Series D.
Series D, we could be fun and say this was Stu Lombard 3 or 4 years ago, Brenda, or something, or would that go be? Series D to me, it could be like, why haven't we gone public yet? Or it could be, let's add some bank debt and maybe a little bit more venture capital.
Over to you, David, dilution.
Dilution is the decline in percent ownership that occurs as you sell off a portion of your company. So let's say $5 million business and you own 100%, and then you raise money. So now someone buys 20%, you only own 80% of it, but you might have raised money at a 10 million valuation. So you're still worth more. You're now worth 8 million versus the 5 million, but you've sold off 1% of the company, and so your ownership percent has declined.
Thank you. Brenda, valuation.
Well, it's like an old boss of mine when I was at Bell said, there's a big difference between price and value. And I mean, practically speaking, which is usually how I like to speak, I mean, value is what the investor's what someone's prepared to pay for something.
Thank you. Scott, cap table.
So the cap table, it's got a bunch of columns at the top, shareholder name, class of shares, number of shares owned, and investment date. That's what I like to see. Oversimplifying it, it's just a list of shareholders and what percent ownership they have. But I like it's a good way to tell the story, going back to what I was talking about.
Thank you. David, lead investor.
So it could be the largest investor, but is not necessarily. It's the person that offers to coordinate the due diligence process for all the prospective investors. And so this person probably is an experienced individual because they know the steps that you have to go through, and they are reviewing the information on behalf of the others. It becomes important, particularly with smaller investors, angels, because you're helping others learn about the process, and also for the entrepreneurs perspective, rather than answer the same question 12 or 20 times, they're essentially answering the questions for the lead investor. That's getting communicated to the others. And then there might be some follow-up from that. But it's the person organizing the transaction.
Thank you. And Brenda, last but not least, exit.
So you're basically selling your company, or there's a merger and acquisition, or there's an IPO, and if all goes well, you as the entrepreneur and the investors will get a nice financial return.
Amazing. So those are the definitions that I prepared. If anybody else has any questions about any jargon that they've heard, please feel free to put that in the chat and we can define those terms as well. I'm going to jump into some of the questions that we've got through the chat. The first one, does deep tech have to be associated with researchers and PhDs?
I guess that's for me. It helps. It doesn't have to be. When I look at the deep tech investing I did before we launched this fund, it was almost always some form of academia, whether it's a school, it's the IP is vending in. It doesn't have to be though. I don't have government regulations that say that I need a certain principal investigator and so on. But as I see things that are going through the NSERC program and the I-to-I granting process and so on, they're almost all academia. I think there's some grants that you absolutely need to be, you need to have a PI involved.
Mm-hmm. From the earlier stage then, David, how important is it for a team to have a researcher or somebody that holds a PhD and have that level of expertise on the team?
So I guess it depends on how technical the solution is. If we're talking about a highly technical solution, then certainly, your CTO needs to be very, very knowledgeable about the sector. Imagine a medical field where you don't have anyone with high-level medical training. I mean, you're probably not going to go there because they're going to deal with competition down the road, and you need to be able to, understand that and understand what the challenges will be. Does someone need a title like a PhD? No, not necessarily, but they need to have a very good understanding of what it is, what business they're in.
Awesome. And then we had already answered the second question about whether investment is just monetary or not. Anything else to add to that about what else investors bring to the table? Perhaps we'll start with you, Brenda.
Well, again, oftentimes they can, help you solve problems, right? So like a lot of entrepreneurs, they've never actually managed people. And so if they find themselves in an HR issue, performance issue, whatever it may be, sometimes the investor comes with more experience to kind of help them, talk them through that, or help find them a resource that can help them with that. So there's that. There's the network again when you're building out your team, accessing really good people. Your investor may be able to open up their Rolodex or Outlook or whatever you want to call it and provide you some names. Also, as an investor, as an entrepreneur, it can be really lonely sometimes because you're in charge and you want to look like you know what you're doing, and so you have to have a good face for the team. But talking to the investors, using them as a sounding board can be great value add. And the one thing I would say is, as you're talking to investors, if you as an entrepreneur, like you don't need them to be your best friend. Like this is not about hanging out with your bestie all day. But if you don't feel you're developing a good rapport and a respectful sort of two-way street communication with them, then you kind of have to ask yourself, do you really want them in your company for the next 5 or 10 years?
Mm-hmm. Mm-hmm. Very well said, because you're going to be working with them for 5 to 10 years, and if you can't stand working with them, then it's not going to work out.
And you want to make sure, like I've often heard someone will say, well, I didn't want to tell the person that because it would hurt their feelings, or I wanted to be nice. When you see someone who needs help or they're going down the wrong path and you don't speak up, that's anything but nice.
Mm-hmm. Mm-hmm. And
staying on this topic, you might flip it around a little bit. And so let's say you don't need anyone's money, that you think you can fund it just with what you're doing. You still want to take in other ideas, and having someone invest in you ties them to the idea that they want the investment to be successful. And so you should think about that. I saw a company about a year ago that this kind of diverges the conversation, and I don't mean to do that, but there was a type of investment that they wanted to do a safe investment. So we can talk about that separately if we want. And I said that our angel group doesn't do safe investments. And his response to me was, okay, but just let me introduce myself to them so they can help me grow my business. And my response was, well, if they're not invested in you, then why would there be an ongoing relationship? Like, everybody's busy. It's one thing to sit down and give somebody 5 minutes of your best ideas, but it's another thing for having ongoing relationships. So sometimes tying an investment with the knowledge is an important thing to do. And the other thing is what an entrepreneur should be thinking about is knowing what you don't know, right? There's all sorts of, you can identify risks and things that you know about that are solvable. But there's a whole bunch of risk out there that you don't know what that risk is. And that's why you want to have an advisory board. That's why you want to have a diverse set of investors, because you can tap into all those people. So when all of a sudden you're struck with, oh, geez, how am I going to deal with this? You've got some people that care about your success that you can reach out to, that have their resources, and tap into people like Brenda and Scott that say, hey, I haven't dealt with this, but have you guys dealt with an issue like this? And so you're tapping into their network. And that's why tying an investment together with advice is important. Pardon me.
Mm-hmm. Very well said. There's an element of network and knowledge and covering your blind spots as well.
Yes, absolutely.
Scott, do you have anything to add to that?
I would just add that every investor should be a good corporate development person. So they should be good at contracts, they should be good at the law, they should be good at accounting. Like those are kind of table stakes. And if an entrepreneur is picking up a vibe that the investor is not good at those things, then that's a bad sign. But somebody raised this, maybe it was you, David, earlier on. Look for the special superpower the investor has too, because maybe they're an expert product marketer. Maybe they're an expert engineer, or maybe they're an expert daydreamer, right? Or maybe they're just somebody that has serendipity, that has 20 companies, and cool things happen between two companies that might randomly never have known each other through that relationship.
Mm-hmm, mm-hmm. So key, the superpower, and that goes to everybody on the team, right? Not just the investor, but what are they really good at, and how does that fit into where you want to go with the company?
Right.
So there's another question here. So when does the conversation of legal and financials come into play? Does that happen before the investment call? Is what this attendee is asking. Um, I'll stop it at that. There are a couple of other follow-up questions to that. When do you look at the legal side of things and the financial side of things?
So I would say that financial is usually before legal. Everyone assumes that the house is in order, because if those things aren't in order, then it can really be a deal breaker. But early stage, you're just trying to get to the concept. What is the company about? What are they doing? But in understanding the concept and the potential of the concept, that's where you start getting into what are the forecasts. And then you get into the financials of, okay, so how's the company structured so that I can understand what the return can be on whatever the revenue is. And as you get into that, then you start to look at, well, how has the company been set up? What are the financials? So the financials come up, in detail in the second or third meeting. Now, the legals usually don't come up until, okay, so who's interested in investing? We're this far, we've done a bunch of questions. Okay, we're ready to write our check. Okay, let's bring in the lawyer to, really look over the contracts and the documents and see legal due diligence, because there's going to be a hard cost with respect to the legal due diligence. And so you don't want to incur any hard costs if you're not going forward with the investment. So that's where I have seen it come up most.
Gotcha. Does that look different for your end, Scott? Brenda?
Brenda, you want to go, or?
Sure. One thing I would say to be mindful of is, most investors know that there's no perfect company, number one, and number two, that everybody makes mistakes. And So the question I used to ask the companies, and I ask the fund managers now, if I were to do diligence like formal due diligence, which is sort of what David's talking about, where would I find the hair on this deal? Like, where is there going to be an issue? Because finding that up front, normally, unless it's out and out fraud, or just a complete lack of judgment on the part of the entrepreneur, you can usually find a way to solve for the issue. If, however, to David's point, you've gone through all this time and oftentimes money, and then deep in the bowels of the legal review, you find something that's material. All of a sudden, you've got a problem very late in the process, and then you have an issue of credibility with the team. And so, it's like it's like when you're kids, like, if you broke your mother's vase, tell her the minute she gets home, don't let her go in the living room and find out that it's broken.
Because she's going to find out eventually.
Absolutely, David.
Yeah. John, the only thing I would add is the question there's an answer that I thought about, which is, if they're asking the question because they're deciding what amount of work they need to get done before they talk to an investor, then I would say that they need to get it all done. I'd go back to, 30 minutes ago, because you never know what question the investor's going to ask, and you always want to be on your toes, right? You want to be prepared. But, as David and Brenda said, yeah, legals are, an investor will issue a term sheet. My term sheet will usually include a non-disclosure clause that if there's stuff that the entrepreneurs don't want to share with me before that, then we can talk about it. But after I've given a term sheet, I'm pretty sure I want to do the deal. And the lawyers will usually be going away in the background, and we'll be incurring legal bills. So at that point, we want to close the deal. But we're still looking for reasons not to, and we don't mind walking away if we find it.
And does that change at all depending on the value of the investment? So if there's an earlier stage company, perhaps looking for $50,000 from you, Scott, versus a company that's looking for maybe like $2 million, does this process change at all, or are any of these elements perhaps more influential, more impactful on how you make your decisions?
I mean, a $50,000 check is easier to write than a $500,000 check, but it shouldn't be. I think there should still be the same discipline. But I don't think I need to see the same path to revenue or the same market validation at a $50,000 check. But to go back even further, that's probably a pre-seed check, John. So if I'm doing pre-seed, then I'm kind of out of my lane. Maybe I'm calling David up, asking him how to do this stuff, and you know what I mean? Like, it's not. Maybe David's better at answering that.
Yeah, and I would say I don't think it changes much, because you really need financials to run your business on a day-to-day basis. I mean, they don't have to be audited financials, but you need your financials in place so that you're understanding what your business is doing. So you'll be incurring those costs, and they'll keep you organized, shall we say. But it's at the point that someone's making an investment that they want to make sure that, in fact, the rights they're getting is what they expect. And again, that's going to be a one-time cost for the transaction. So that's why people like to kind of leave it to the end to say, okay, if everything else is good, I buy into the concept. I like your marketing strategy. I like your financial strategy. I like the people. Competition's okay. So I bought into all that. Now I'm about to, we're exchanging a document that says this is what I get for my money. Okay, let's make sure the wording is what we think it is, and let's make sure that, in fact, those people that are on the team are actually on the team. They're not on some other team, and that they have the same incentive that we think they have.
Got it. All right. And the last follow-up question from this attendee is, do you invest in SMEs or one-person businesses? I anticipate what the answer would be. So if not, what other resources are available for SMEs that might not be as focused on innovation or one-person businesses? Perhaps let's start with you, Brenda, to talk about the trends that you see amongst other VCs as well.
Well, I mean, what I see amongst VCs is that there typically has to be some underpinning of technology in the business, right, for it to be investable. I think, what your attendee may be speaking to is what I might call lifestyle businesses, where, you've got a good idea, going to have some customers. Chances are you'll probably, give all your investors a really nice dividend every year, and everyone can go and buy a cottage or, a nice car, that kind of thing. But it's not a business that's going to be going IPO or what have you. And we need businesses like that, and we need entrepreneurs like that. So I think in those cases, then the kind I think back to one, I hate to name names, but there was one company, I think it was called Chickpea Pasta out of the Barrier out of the north. And I remember talking, David, you might remember the story, talking to the Angel Group, and one of the individuals actually got involved with the company. It was a story, he liked the company so much he went and invested and worked for it, and now it's a roaring success. And Chickpea Pasta, on the face of it, most people would not term a technology company, but it's a great business now. It's in the stores, are exporting it. And so I think, going back to the entrepreneur, like, why are you in this business to begin with? What are you hoping to accomplish? And then, you think of people like BDC, where they do debt financing on small and mid-sized business. You think of the Canadian Business Growth Fund, there's all sorts of other, it's not just all VCs and all angels. And even within angel groups, I'm sure David will speak more to this, but there are angels who will invest in sort of more traditional businesses because, of course, they're looking for a financial return. A lot of them maybe want to give back to the community, or they come out of the sector, maybe it's some packaged goods, and they just really know it well, and they want to stay engaged in an investment. To David's point, is how they do that.
Mm-hmm. Mm-hmm. Yeah, absolutely. And it's very individual. The trend seems to be focused on that high exit, right? That market potential, that IPO. But there are instances where investors invest in a company that they might not see that potential, but they just love the company so much, right? So
there's nothing wrong with a nice dividend stream, right?
Mm-hmm. Yeah, that's why a lot of people invest, right? To get that drip.
It has to do with risk and reward, right? So if you see a business that is, nice, steady business that is paying off a dividend, so okay, I'm going to pay a certain amount for that business because I can. So really, what my risk is something going to happen in the future that changes the competitive nature, that undermines that dividend stream. But that can be good from an entrepreneurial perspective. Investing in an early stage company that's going to take over the world, I mean, there's a lot of failure in that market environment, right? I think the stats out of the US and their angel group showed that, this was an angel group in California. So wouldn't you love to be based in California investing in companies? What a great environment. Well, 25% of their investments over a 20-year period went to zero. 25% they lost money on. So 50% of their portfolio were not successful. Another 20 odd percent they just broke even on. And it came down to about 3% of their portfolio that actually gave them a huge return. So this is, very risky stuff. And those are guys that you would think have known how to pick, unicorns and seen many over time, and they must know how to do it. But so it's a very risky environment. And so if that's the case, if I'm doing that kind of investing, I can't invest in something that's just going to double my money, because the chances are I'm going to lose all my money. So I need something that's going to give me, a 10 bagger, 10 times return, 50 times return. So that's, I have to keep that in mind as I'm doing the investment. And from the entrepreneur's perspective, they're sitting there saying, no problem, we're going to be $100 million business. Of course we are. Otherwise, we wouldn't be doing this. And it's like, okay, so the chances of you being a $100 million business are actually really, really small, really small. So I have to take that into consideration when I look at what I'm going to pay for your business.
Mm-hmm. So there's a bit of an element of shooting for the moon and land among the stars, because the percentages and the success rates don't seem to be very favorable.
Right. But you try, you do the best you can, but it's just a lot of things have to go right. You have to have the right team, you have to have the right products, you have to have the right environment, the right economic situation. A lot of things have to go right over time, right? You can have a successful business for 7 years that goes bankrupt because, they didn't get the financing right or whatever. They missed a window or a competitor came along. I've seen public companies. There was a company out of Ottawa called Fulcrum years ago that was the best search engine in the marketplace, better than Google. At the time, Google wasn't established, better than Yahoo. and they had a rebate program with Microsoft, and Microsoft would pay them a chunk of money. After the year, Microsoft would decide how much they needed to pay Fulcrum. And one year, Microsoft decided that the rebate was going to be smaller than Fulcrum expected. And that meant that their results disappointed and their stock tanked and they needed to raise money and they couldn't and they went bankrupt. So this was a company that started from nothing, had leading edge technology, got to being public and went bankrupt. It's tough. And so investors take all that into consideration when they give you money, that, you know, there's a lot of challenges ahead.
There's so many variables at play, and it's not just about the technology, it's about the business as well. But I can't imagine, you know, if somebody were to ask me a question, I told them, hey, go Fulcrum it, which is very interesting story.
Having said that, you know, we learn a lot from our successes, but you also look around to some of the companies who haven't done so well. Sometimes it's really no fault of their own, like, you know, the market turned on them or, you know, whatever. But oftentimes those entrepreneurs and those employees will go on with a next idea and they'll learn from the experience, or they'll join a company that's already scaling up and they'll bring along that experience and apply it to that. And we're getting a really robust ecosystem now of people who've sort of been there, done that, and they apply the learnings to the next opportunity.
There's a bit of a track record that gets looked at as well from the entrepreneur side. Scott, do you have anything else to add to that point about investing in SMEs, lifestyle businesses, one-person businesses, places that don't? Yeah,
I think it's an important part of the economy, right? And it's not right for me as an investor to back those sort of companies for reasons that I think, David, you did a great job explaining, the focus on the huge windfalls. I would say, like, how do you get help with you're an SME business owner? Like Chamber of Commerce, John, things that you're working on. You know, Brenda, you and I, we talked about Tim Jackson a little while ago. When Tim and the group were starting up Communitech 20 whatever years ago, I think they just got together for breakfast. And I think it was just businessmen and women that were helping each other out. And those companies, I bet you, there are a lot of lifestyle companies in there, right? And they weren't all great venture capital investable businesses, but they support each other. And I think that's where, if you go to a bank and you want SME funding, the bank is going to ask you for a personal guarantee, I'm sorry to say. And they're going to do a credit check on you, and that'll determine if they can back you or not. And so there's not a lot of other opportunities for that capital in Canada.
So they are, you know, as you said, Scott, a very important part of the economy. And, you know, you mentioned Chamber of Commerce, Brenda, you mentioned BDC. There are lots of places that support, and, you know, even here at MBEC, we have the Starter Company Plus program, the Summer Company program, and we had another session of finance options where Futurepreneur was at the table as well. So there are lots of funding options and organizations that support small medium enterprises, that support one-person businesses, Main Street businesses, and brick and mortar stores. So if anybody is wondering about how they can grow a business like that, definitely reach out to MBEC, check out the recording on finance options, and reach out to any of these, you know, centers that we've mentioned. So with that, I don't see any other questions in the chat. We have about a minute and a half left. Any last thoughts, David, Scott, Brenda, that you want to provide in the next minute and a half or so?
I would say with entrepreneurs, I mean, you know, it's hard, right? That's why not everybody does it. Having said that, there's lots of resources. So, I mean, my parting word would be just keep going.
Thank you.
Lean on the community. Community's there to help. Look for people with experience, either building something or in the industry that you're trying to tap into, because there are resources around.
Well said. Thank you.
I would just say, look to Twitter, look to LinkedIn, look to BetaKit, look to AngelList, and just get to know the community. And I'm sorry I haven't been more visual on this chat, John. See if my phone will die or not.
It's all good. It's all good. Thank you. So thanks so much for those closing thoughts. Keep going. Reach out to the community. Do your research. Find information online. Seem to be the closing thoughts. And if anybody here on the session or watching the recording has any questions, please feel free to reach out to me. With that said, This is our last session of the ScaleUp series, part of this program pilot, the ScaleUp program pilot that we've been running since October. We've been so grateful to have all our speakers, David, Brenda, Scott, to have you here in this session, and all the other speakers from the other sessions. And so happy that the attendees were able to join us. So thank you all for being here. We look forward to seeing you in the new year, and lots of news coming down the pipeline about where the ScaleUp program pilot is going to head and how we will continue to support scaling innovative companies. So with that said, thank you again, everybody, for being here. Hope you enjoy the rest of your day.
Merry Christmas, happy holidays.
Good luck for the holidays and into 2022. Bye-bye.
Thanks, everybody.
Thank you. Bye.
Everything. Bye-bye.